It is a late Friday night here at the Doc Shaw Financial Headquarters, but I really wanted to make this video for you guys. So I sat down and I said, you know what, I'm just going to go for it. In today's video, we're going to go over the three main types of investment accounts. We've got tax deferred, taxable, and tax-free. This is really where I start when I'm talking to new clients in terms of getting them to understand their portfolios and the different potential taxations that will occur. And we're going to go ahead and take a look at the slides here that I use for the retirement planning course that I teach at Johns Hopkins University, where I went to college. So let's go ahead and break this down, and you're going to understand exactly how these accounts all work by the end of this video.
Lassie must be missing.
Tax deferred accounts are pay tax later. That's how you want to think of these accounts. Taxable accounts are pay tax as you go, and tax-free accounts are pay tax now. Tax-free is a bit misleading, and we'll get into why in just a second. But that's how you want to think about these accounts. So let's start with tax deferred. And let's use a traditional 401k as an example, because that's what most of us are probably very familiar with. In a tax deferred account like a traditional 401k, the contributions that you make are tax deductible, meaning that you get to exclude those contributions from your taxable income. So just for example, if you're in the 22% marginal tax bracket and you contribute $10,000 to your 401k, great. That $10,000 is taken out of your total income and it's not included, therefore, in your taxable income. So you're not taxed on that $10,000. You've shielded $10,000 from being taxed today. Now, a light bulb might be going off in your head and you might be realizing, okay, that seems very advantageous if my tax rate is really high. And that's true. Tax deferred accounts, generally speaking, are very good for high income earners, although they're great for everybody, but particularly for high income earners because they get to shield a lot of their income from very high tax rates. Somebody in the 37% tax bracket saves $3,700 in taxes for every $10,000 they put in their traditional 401k. Now, a lot of those taxes do ultimately get recouped down the line, but before we get there, let's look at how the account grows. So we know that in a tax-deferred account, we put money in, we get a tax deduction that year. Now, all of the gains in that account grow tax-free. Doesn't matter if your account goes up 1.5 times, 2.5 times, 3.5 times, it doesn't make a difference. Everything just continually grows tax-free. Ultimately, when you pull that money out in retirement, you're going to get hit with an ordinary income tax bill for all of your withdrawals. That is how the tax deferred account is taxed. Tax deduction in the year that you make your contributions, all the growth is tax deferred, and then when you pull it out in retirement or whenever, that is when you get hit with ordinary income tax. For the taxable account, we'll use just a simple brokerage account as an example. In a brokerage account, you're using after-tax dollars. So these are dollars that are not excluded from your taxable income. So you made some money, you put some money in a brokerage account, you'll still get taxed on that if it was income in that year. But the beauty of a brokerage account is that you have ultimate flexibility. You can buy individual stocks, you can buy bonds, you can buy options and derivatives, all kinds of different types of investments. Some good, some not so good. But you can buy essentially anything your heart desires, and there's no contribution limit. So it's a very flexible account. There's no age requirements for the account as well. And we'll get into kind of the mechanics of these accounts in just a second. But the brokerage account has different taxation. In a brokerage account, all of your interest is taxed at ordinary income rates. It's no different from your tax deferred account. But capital gains, long-term capital gains specifically, are taxed at a very favorable rate, anywhere from 0 to 20%. And so you can kind of see that, well, the tax deferred account, you get to defer all these taxes, but you are going to pay ordinary income tax in the future. Whereas with the taxable account, if you've got long-term capital gains, you'll pay the long-term capital gains tax, not ordinary income tax. And the long-term capital gains tax tends to be more favorable. Now, dividends could get taxed at preferential rates, or they could get taxed at ordinary income. That's beyond the scope of this video, but generally speaking, when we think of the brokerage account and the stocks that we're buying, we're looking at long-term capital gains tax. If you have a gain in a stock that is held for 1 year or less, it qualifies for short-term capital gains tax, which is just the same as your ordinary income tax rate. But the brokerage account is pay tax as you go. Every year that you realize a gain, you pay tax. So it's not tax deferred like how the traditional 401k is, right? All of those gains, right? No matter what you buy and sell, you're not paying any tax in the year that you recognize gains in those accounts. But in a brokerage account, when you realize a gain, you've created a taxable event that moment, and you will have tax due for that year. Now, in a tax-free account, that's the flip side of the tax-deferred account. Now, tax-free, like I said, is a little bit misleading. All of the growth in a tax-free account is tax-free, like a Roth IRA, if you follow the rules, which is have the account open for at least 5 years and be 59 and a half or over when you pull the money out. But in a Roth IRA or a tax-free account, when you make the initial contribution to that account, you will pay tax. It's an after-tax contribution. So it's included in your income. It's not like the tax-deferred account where you're excluding it from your income. Now, in that Roth IRA, once it's funded, all of the gains in that account become completely tax-free. So it doesn't matter if you buy a stock and it goes up 5 times, 20 times, 100 times, as long as you're over 59 and a half, and as long as you've had the account open and funded for 5 years, all of those gains are completely tax-free. So you might be sitting there and thinking, if the traditional 401k or the tax-deferred accounts are good for high-income earners, maybe the Roth would be good for lower-income earners since they're sort of the inverse. That is true, but again, they are good for everybody. It's not an overarching generalization. But yes, lower income earners benefit from a Roth because they can make contributions at lower tax rates. And ultimately, when they're in higher tax rates down the line, it won't matter because all of those gains are now tax-free once they are inside of that account. Now, the Roth IRA does have income limits, and we'll put that on the screen here as an overlay. But those are the 3 types of accounts and how they work. So let's go over them one more time, just like I go over them for clients of Doc Shaw Financial. Tax-deferred accounts, you get a tax deduction in the year you make a contribution. You have tax-deferred growth over time, and then you pay ordinary income tax when you pull the money out. In a brokerage account, you're using after-tax dollars, and you pay tax as you go. As you recognize gains, you pay tax according to the type of investment and its holding period, how long you held it. In a tax-free account, you pay tax to make the contribution in the sense that it is an after-tax contribution, and all of the subsequent gains are tax-free. So now I want to talk a little bit about the contribution limits, and I don't want to bore anybody to death, but I am going to take a look at some of these slides here that I created, and I'll walk you through everything. So in a traditional IRA, that's a tax-deferred account, your contribution limits, if you're less than 50, are $7,500. If you're over 50, it's $8,600 because you get an $1,100 catch-up. You have penalty-free withdrawals after age 59 and a half. And you have RMDs that will kick in at age 73 or age 75, depending on your birthday. If you're born in 1960 or later, it's age 75. RMDs are just forced withdrawals from your traditional IRA or your tax-deferred accounts. Essentially, the IRS is not going to let you defer paying taxes forever. So once you hit a certain age, they force you to take money from those accounts. And I'll make a separate video on that. And if you want to see it, make sure you subscribe. Your 401k, 403b, 457, these are all sort of blends of the same, type of account here. And the contribution limit, if you're less than 50, is $24,500. Between 50 and 60, you're looking at $32,500. Between 60 and 63, you're looking at $35,750. Now, that is just the employee contribution. In these accounts, these 401k, 403bs, these employer-sponsored plans, you also have an employer side that they can contribute to. It's not just the contributions that you can make. So the total limit of these accounts is $72,000 between the employee and the employer. Penalty-free withdrawals at 59 and a half and RMDs at 73 or 75, just like the traditional IRA. Now, the solo 401k is a little bit different. That is actually a retirement account for individuals who own their own business and they are the only employee, or their spouse is the only other employee. We won't cover that in this video. Maybe that'll be another video, but you've got some information on the screen if you want to pause. The brokerage account, like I said, is the most flexible account. There are no contribution limits, there's no age restrictions, and there's no RMDs. It's just you put money into the account and you can pretty much buy whatever your heart desires. Now, your tax-free accounts, right, your pay tax now accounts, that's like your Roth IRA, your Roth 401k, and even your HSA, your health savings account. Your HSA, you only qualify for if you have a high deductible health insurance plan, so not everybody will have an HSA. But we'll focus on the Roth IRA and the Roth 401k for right now. The Roth IRA has a $7,500 $800 contribution limit for 2026. If you're over 50, it's $8,600. It's just like the traditional IRA, by the way. There are income limits for the Roth IRA, and we put that as an overlay just a second ago, but we can put it up here again for just a quick second if you want to pause and take a look. Your account has to be open and funded for at least 5 years, and you have to be at least 59 and a half for all of the withdrawals to be tax-free. Now, in your Roth 401k, it's the same contribution limit as your traditional 401k. It's $24,500 plus the same catch-ups that we had just a second ago. The catch-ups being, depending on your age, if you're 50 to 60, you get an $8,000 catch-up, 60 to 63, $11,250 catch-up. And your health savings account here, you got a contribution limit of $4,400 as an individual, $8,750 as a family, and you've got a $1,000 catch-up if you're over age 55. There's no RMDs in any of the tax-free accounts. So the Roth IRA has no RMDs, the Roth 401k has no RMDs, and neither does the HSA. So that's it in a nutshell, guys. I hope you enjoyed the video. These are things that I cover with all the clients of Doc Shaw Financial. We make sure that we save you tens of thousands, if not hundreds of thousands of dollars in taxes over your lifetime. Shoot me an email at raul@docshawfinancial.com. I want to hear from you and your personal situation to see if we can partner together. Otherwise, subscribe, and I'll see you in the next video.